We know that in order to achieve the benefits of long-term compounding, we must limit our portfolio drawdowns to normal bull market corrections, and also hold securities that have the right characteristics to increase in value. Our Canterbury Portfolio Thermostat is designed to maintain an efficient portfolio through all market environments. Now, an efficient portfolio is a moving target. An efficient portfolio in a bull market may look much different from an efficient portfolio in a bear market. There are several internal benchmarks we must meet to have an efficient portfolio. And this is why at Canterbury we have combined these internal benchmarks into an all-inclusive portfolio efficiency score. If our efficiency score is in check, then we know that our portfolio has characteristics to limit drawdowns to normal corrections and help us achieve our primary goal of long-term compounded returns. I will now move over to the smartboard where Tom and I will demonstrate. At Canterbury, our goal is to create an efficient portfolio. And one thing that we know about markets is that they're always changing. So therefore, in order to create an efficient portfolio, we need an adaptive methodology capable of adapting to those various market environments. And in order to have the efficient portfolio, we need to meet several key internal benchmarks. So at Canterbury, we have developed these internal benchmarks into an all-inclusive portfolio efficiency score. And we know that if we have an efficiency score somewhere between 70 and 100, then our portfolio has the capabilities of limiting drawdowns to a normal bull market correction of somewhere between 10 and 12%. So to break down this portfolio efficiency score for you, there are periods of efficiencies and inefficiencies. They're comprised of basically three internal benchmarks, and those benchmarks are security states. Are we holding securities that are trading efficiently? And are we combining those securities in a way that causes our portfolio to trade efficiently? Second is the Canterbury Volatility Index. And the Canterbury Volatility Index is designed so that if we have low and stable CVI or volatility, then our portfolio is not exposed to the irrational movement of bear markets. And lastly, we want to talk about an efficient benefit of diversification. So typically when you hear the term diversification, it's referring to broad diversification and how you want to combine various asset classes in order to, when one asset's going up, it's offsetting the assets that are going down. Well, at Canterbury, we talk about the efficient benefit of diversification, how we want to combine securities that all have the right characteristics to both go up, but are diversified enough that they're all not highly correlated to each other. So I want to invite Tom Harden back up, where together we'll go through each one of those benchmarks one by one. Our portfolio efficiency score, again, combines those three internal metrics. The first of which is a bullish portfolio or an efficient portfolio. Are we holding securities that are trading efficiently, and when combined into a portfolio, cause our portfolio to trade efficiently? The answer is on the portfolio thermostat.
So I'll check that off and say that on this day that is an efficient portfolio.
Is our volatility stable? Are we keeping that within a rational range so our portfolio always behaves like it is in a bull market? Tom?
A lower decreasing volatility, and we would say that's true today.
And do we have an efficient benefit of diversification? So if we're in a bull market, we don't want to see that fall too low, and or get too high. And in a bear market, we really just want to stabilize the portfolio by holding assets that have sort of a random correlation to one another. So in today's environment, Tom?
We would say that's true. So again, we talked about the security states, which really range from 1 to 12, but really they're either bullish, transitional, or bearish. So if we say our portfolio is in an efficient or bullish security state, that's checked off. If our volatility is below 75, then that'll be checked off as long as we aren't having some spike in volatility within the portfolio. And then our percent benefit of diversification. If we're in a bullish portfolio environment, is our portfolio benefit of diversification higher than 25%? So in that case, we'd say today our portfolio is efficient.
And if these three internal metrics are true, then we will have a portfolio efficiency score between 70 and 100. And again, what that means is today our portfolio is efficient. Therefore, our risk is limited to a normal bull market correction of somewhere between 10 and 12%. But our portfolio also has the ability to compound.